Hello, this is Brian Novak, Senior Managing Director, Portfolio Manager with Aster Investment Management out of Chicago. Thanks for joining us today. Today we're going to be talking about three things. One, the history of Aster, the principles that guide our investment process. Secondly, we're going to be talking about some issues facing income investors in the current marketplace today. And number three, the solutions that Aster's created to help address these particular problems to help create better risk-adjusted return profile strategies for investors that help keep them disciplined, maintain positions throughout investment and economic cycles. So Aster was founded in 2000. We manage approximately $1.8 billion across multiple dynamic allocation strategies. Founded in 2000 by Rob Stein. Rob's background was at the Federal Reserve under Paul Volcker's regime. Before moving to Wall Street to manage a currency book over at Barclays BZW. He is joined on the investment committee by our CIO, John Eckstein. John's background is in quantitative investment management, specifically focused on computer programming and overall macro analysis. Myself joined Rob at Aster in 2002. Prior to that was a options trader at the CBOE Options Exchange here in Chicago. We're also joined by Deepika Sharma. Deepika was named in 2015 as the Young Investment Professional of the Year by the New York CFA Society. Together, we have approximately 75 years of investment management experience, culminating with various disciplines in investment management to help guide these dynamic portfolio strategies to help investors create better outcomes, risk-adjusted outcomes in their portfolios. So there's three core competencies that Aster bases our strategies on. Macroeconomic analysis, that is the lifeblood of the strategies that we run. Everything we do is based off of looking at macro indicators to determine how we should position our portfolios. This results in these dynamically allocated portfolios, not market timing, but dynamic strategies that look to adjust positions based on what the economy is doing and how we view the risks in the current environment. We implement the strategies using efficient investment vehicles. What are these? Exchange-traded funds. We are one of the pioneers in all ETF portfolio management. We've been utilizing these for approximately 15 years. We find them to be a very efficient and economical asset allocation tool to help us implement the strategies that we are employing. This is all the base of the Aster strategies, this approach. And we've created what's called the Aster Solution Series. These are a series of strategies that are designed to help investors of various risk profiles and objectives to help them complement traditional passive portfolios to help them manage risk and create a more smooth profile within their investment accounts to help them manage risk and return through economic and cycles. They focus on dynamic allocation, sector allocation, active income, which we're going to be talking about today, as well as our global macro strategy. Really, the base of what we're trying to do is here on this chart. We're trying to identify where we are in the current economic cycle. Are we in contraction, trough, expansion, peak? These are all concepts we're familiar with, but helping to identify where we are in this particular cycle can help us determine what assets we should be allocated to, as different asset classes and market segments behave differently based on where we are in the particular cycle, and that's what we're trying to identify. This really represents just a calendar. There's hundreds of data points that come out on a monthly, quarterly basis, and really what we're trying to do is distill them down, eliminate the noise so that we can determine which ones are relevant in determining where the economy is actually going, what the direction is, and the velocity of the movement in the economy in itself to help us position our portfolios. It all culminates in what we call the Aster Economic Index. This is a real-time snapshot of the economy. Simply, we're trying to identify again where the economy is, and we measure it and assign a data point to it, and that data point is reflected by this blue line here. The higher the blue line, the more risk exposure we're typically going to have in a portfolio, and the lower the line, the less risk. And as you can see by the shaded gray areas on this chart, what we're trying to do is identify when those periods are occurring by measuring the economy, because those periods have a tendency to be associated with weak investment performance, market performance, as well as recessions and drawdowns that are typical in those types of periods that can be detrimental to investor portfolios. So looking at this chart, this is our economic index, the blue line overlaid with the S&P 500, and all this is done is to indicate that we're trying to identify where the economy is going, because it has a tendency to correlate to the market movement, risk asset price movement over time. And if we can identify the movement in the economy, it can help us get a better idea of how we should be positioning our portfolios to help investors. So this is one of my favorite charts. This was a study done by Callan and Associates last year, and really what it's showing is that to achieve that 7.5% target return that everyone talks about, in order to achieve that in 1995, all you need to do is invest in bonds. You could get a 7.5% expected return with a 6% standard deviation. Fast forward that 20 years to 2015, and in order to get that 7.5% return, it came with a substantial amount more risk, 17.2%. So really what this is telling us is that we've had to take on more asset classes, more risk in the portfolio to help investors achieve that return, and that speaks to having strategies that are focused on risk management in order to help tip the scale a little bit more in the investor's favor to help them achieve their goals, which has a tendency now to come with more risk than it has in previous decades and years. So the Asset Income Active Income Strategy is our dynamic allocation, unconstrained income strategy that's focused on the income market to help income investors achieve their objectives, achieve higher rates of income, higher rates of return in their portfolios. But we're doing it by analyzing the economy, analyzing key risks that are associated with income investments to help them sidestep risks when we see them present and allocate to parts of the market that we find supported by the current environment to help them achieve income at the right price of risk. So this right here sort of spells out what the risk looks like for income investors today. So going back to the late 80s, early 90s, you could see that achieving yield, that blue line, came with a level of duration or interest rate risk that was substantially lower. You could get approximately 10% yield with approximately approximately 5-ish duration. So fast forward that now, you're getting roughly 3% yield, but the duration of the interest rate risk has increased substantially, and that's actually flip-flopped on investors. So they're having to take much more risk for much less yield, and that's the problem for income investors today. So how do we address that? What do we do to try to help investors focus on this particular problem? So we look at interest rates, we look at credit, and we look at the macroeconomy. By identifying interest rate movement, looking at FOMC policy, Treasury yields, so we can identify which way rates are going. What does that help us do? It helps us adjust our exposure to areas of the Treasury curve, the yield curve, that is susceptible to interest rate movement. If rates are looking like they're moving higher, we're going to lower our exposure to securities that are going to be sensitive or negatively impacted by higher rates, higher interest rate movement. We also look at credit. This is an important component for yield investors. High yield and credit investments tend to be the area that investors look at, and this can be supported positively or negatively by the credit environment, by the risk environment. So we look at credit spreads to determine are conditions tightening? Are they more supportive for credit investments, or are spreads widening? Is the economy getting worse? Is that going to be more detrimental for positions in high yield and more credit sensitive investments? So lastly, we look at macro. As I mentioned, with credit, that has an impact on the credit market, but it also has an impact on equity dividend yields. So we think that's an important component that all income investors should be looking at. We can implement up to 20% of our portfolio in equity investments, but we will look at the economy, and if the economy is moving lower, if it's decelerating, looks like we're headed to recession, in that type of environment, we'll have less exposure to that particular asset class. So based on these three pillars, we'll adjust our exposure to rates, credit, and equity, depending on how we see the environment shaping up. So what does that look like over time? As you can see on the left side here, historical allocation in the portfolio to various asset classes, market segments like high yield, investment grade, senior loan, and others. And on the right side, this is important because this shows our duration exposure, how much exposure we have to various parts of the interest rate curve, short, intermediate, or long. As you can see, over recent years, our exposure to the short end of the curve has increased, while exposure to the long end of the curve has decreased as we've seen the rate environment going to more supportive for higher rates. So what asset classes do we look at again, and how do we view them? So on the left-hand side here, these are asset correlation tables. We're all familiar with correlations, and why are they important? Because putting them together in the right pieces can help, one, diversify the portfolio. But what this shows us also is that these are all income-producing assets, and they don't have the same tendency to correlate to one another. They behave differently based on different market environments. So if we can identify where we are and we can allocate appropriately to those asset classes, we can diversify the portfolio and achieve yield with less risk in the portfolio. On the right-hand side, this is simple. This shows us what the standard deviation mapped against the current yield for various asset classes are, and that helps us get a picture of where we're allocating and how much risk we're taking for the component of yield in the portfolio. So this is a snapshot at the end of the first quarter of what our portfolio looked like and the allocation to each asset class as well as each market segment. And on this page here, this is a return profile of the strategy versus our benchmarks over time. One thing to note on this page is the yellow line on the top chart. That's the correlation, rolling 9-month correlation of the active income strategy versus the Ag Bond Index. And why is that important? That shows that we have the ability to change the profile of the strategy, and it can have a diversifying effect with a traditional income strategy like the Ag Bond Index by having a different profile, a different return sequence that helps to diversify the strategy. Also looking at different areas of the market to look for yield that we're seeing right now. What opportunities do we see based on the risk in the current environment? So that's a brief outline of the active income strategy. We've created this particular solution to help investors achieve their income goals as we move into a potentially higher interest rate regime, as indicated by Treasury yields, also by Fed policy. We think solutions that can complement traditional income strategies can help investors as we move into this new rate regime. And Aster has been around for 15 plus years. We create these strategies specifically to help complement investors' traditional allocations and to help advisors implement portfolios that can help investors stay invested, stay disciplined, manage risk, and achieve their long-term goals. So based on the information, we'd love to help you out. If there's anything we can do, please reach out to us. We'll contact you if you have any questions. Again, this is Brian Novak, Portfolio Manager with Aster Investment Management. Thank you.